Okay. Well, thank you everyone for joining us today. I'm really excited about today's session. We have a great topic and great speakers. I'd like to introduce our speakers, Chris, who leads our financial advisory team over here at Secfi, Adam Nash, who is the CEO and co-founder of Daffy.org. As well, you'll see on here some of the Daffy team members, Chelsea, who leads marketing, and Danielle, who's the community manager. And I am Martin. I lead brand and content over at Secfi. The three of us will help manage any questions that you may have or answer any of your comments. Please feel free to ask any questions or chat during the presentation. We will save time at the end to answer many of these, but yes, again, feel free to ask them as they come up. Um, Otherwise, I am going to go ahead here and we're going to get started with Chris and Adam. Super excited. I think this is a great topic. And here's our agenda for today. So I already did the introductions. We'll go into tax strategies, then tax planning considerations, the power of a donor advised fund. And then we'll actually take a look at some case studies as it comes to taxes and equity compensation. As I said, we'll leave plenty of time for Q&A. All right, well, here we go. Chris, I think you are going to take it off from here. So here we go. Why financial planning?
Yeah, thanks for the introduction, Martin, and thank you for everyone for attending. Really excited to be talking about, charitable giving is one of my favorite financial planning topics to be able to chat through with clients. And I think I always like to start by the why behind this. Obviously a lot of folks are here today to talk through some tax strategies and then to learn more about, more powerful ways to do charitable donations. But really, those are just two kind of core topics of a broader, your broader financial situation. And so when I think of financial planning, really it is helping you to live the life you desire with the money that you have today and avoiding blind spots and being able to get from where you're at today to where you want to go, in the most efficient manner. So, next slide, Martin. That could mean a life event such as starting a family or, transitioning to a new, job, or it could be a, trigger moment. Maybe it's your company that is going through an IPO, and there's a lot of questions that you have. And so you can see here, these are, the multitude of questions or topics that one might be thinking about in their financial life, and taxes certainly play a big part in it. And charitable giving can be one way to lessen your tax exposure and ultimately fulfill and be able to be generous like you want to. But there's a lot of moving pieces in that, and really financial planning is to help you kind of sort through all those pieces and ultimately help you to do what you want to with your money. So with that, before we dive into some tax strategies, we have a poll to kind of kick off just to see where people are at. So the first one, and Martin will launch this, is how much do you know about tax planning strategies? Is it, next to nothing, you've done some research, or, you're an expert already?
All right, I see some numbers coming in. We'll give another second for everyone to answer. All right, Chris.
Let's see what we got.
It looks, yeah, it looks like most people have done a bit of research, but they're not an expert. So 75% of you, 19% of you said next to nothing. And there's a 6% of you that said you know a lot already, which is great.
All right. Well, for those that know a lot already, maybe I can, pull something new out. But for those of you that, don't know, much or have done a little bit of research, hopefully I can, help you to learn some new strategies or just validate some of the things you already know. So when I think about, creating a tax strategy, the first thing I think about is, what are legitimate tax strategies, or what are legitimate ways that are fully, legal to be able to lower your tax exposure? Because not everything you see out there on Twitter or Reddit or TikTok is a legit tax strategy. So first and foremost is saving on taxes is important, but we want to do things that are legit and going to keep you out of trouble. So with that, if you go to the next slide, Martin. So kind of a framework to think about this is tax planning 101. couple things I want to just talk through is, tax deductions and tax credits. A lot of folks, use those terms interchangeably. They are two separate things. So simply put, a tax deduction is reducing your taxable income, whereas a tax credit is going to offset your tax liability. So tax credits are more powerful because a tax credit is a dollar for dollar offset to your tax liability. So if I had a $1,000 tax deduction and I am in the 35% bracket, I'm going to save $350 for that $1,000 tax deduction. Whereas if it was a $1,000 tax credit, that lowers my tax by $1,000. So tax credits and tax deductions, two different things that sometimes get interchanged. But tax credits are more powerful, and a couple tax credits out there would be if you have paid alternative minimum tax in the past because you work at a startup, you are eligible to recover that in future tax years. If you purchased an electric vehicle, there's an opportunity to receive a tax credit from that. Having children, you may be eligible for. There are certain phase outs for your income, but those are tax credits. And then a tax deduction might be contributing to a retirement account or a health savings account or giving to charity and being able to use that as an additional deduction. Another thing to think about is, because tax deductions are going to be reducing your taxable income, they're more powerful in high income years. So I think a lot of our audience, they probably have equity comp. They are in the tech industry. So let's say that you are vesting RSUs. This year has been a really exceptional year in the stock market, and a lot of tech stocks are up significant amounts from where they were at the start of the year. So if you're vesting RSUs, it's very likely that this year, 2023, is going to be a much higher tax year than what last year was. Maybe you're in sales and you've had some big deals that have closed, and so your commissions are going to bump up your income. Maybe you're a business owner. Those are all scenarios where 2023 may be an abnormally high year, and so a tax deduction is going to be more powerful for you this year because you're in a higher tax bracket. The other thing I like to help just to frame up at the outset is saving taxes over the course of one's lifetime is going to be a lot more powerful in kind of how we think about creating a tax plan than just saving taxes in a given year. There's some things that we don't know for sure. So what are tax rates going to do in the future? But we do know that there's some decisions that might lower your taxes in a given calendar year, but it might actually make you pay more taxes over your lifetime. And from a planner perspective, that's not an optimal tax strategy. So when I think of a tax strategy, it's going to be thinking about taxes both in the present, but also in the future, and trying to help you pay the least amount of tax in legitimate ways over your lifetime. Next slide, Martin. So, thing to note here is there's a bunch of different types of taxes. Some of these you may have heard of. Income tax and short-term capital gains tax, you're going to realize those are the same rates. And those are the higher ones, as opposed to alternative minimum tax. For those of you that have been granted incentive stock options at a startup, you may be familiar with that. And then long-term capital gains. So this is going to be the lowest. And I think, for a lot of our audience that has equity compensation, especially if you have stock options, the name of the game with stock options is trying to get as much future growth of your company stock at the lowest possible tax rate. And to do that, you have to get exercise to start the holding period so that you can be able to get long-term capital gains or that bottom row when you do eventually sell the stock. Now, there are some risks for that, and that's another topic, and how we think about that is managing the risk, but also setting yourself up to retain as much upside as possible. But just notice not all taxes are treated the same. And then the other thing is, for a lot of people that we work with, they may have bounced around and relocated to a different state over the years of working at a company. And so living in multiple states it can cause some tax complexities because if the equity was granted in one state, you may still owe tax even though you're not living there. In California, where a lot of tech employees live, has some pretty onerous tax rules, and they're very particular on making sure that if they are owed taxes, they will get that. So if you've transitioned states, I think it may be warrant working with a CPA or financial advisor just to make sure that you're not missing any taxes due to a previous state. Next slide, Martin. So itemizing versus a standard deduction. And where this is relevant is a lot of people ask, Chris, am I going to get any tax benefit for my charitable donations? And like most things, financial planning, it depends. So the standard deduction is what the IRS gives to all taxpayers. Now, it depends on if you're filing as a single filer or as a joint filer. The standard deduction for single individuals is $13,850. The standard deduction for married couples is $27,700. So if itemizing your deductions, and I'm going to walk through what are eligible itemized deductions, if those are greater than the standard, it's going to be advantageous for you to itemize your deductions. If they're lower than the IRS standard deduction, you can think of that as the freebie amount that the IRS gives you, then the standard deduction is going to be the route you want to go. So now thinking about, what are eligible itemized deductions? So medical expenses, but it's only if they're equals over 7.5% of your income. So this would be a really high medical year. Where I see this sometimes relevant is if a family is in the process of IVF or surrogacy and they have significant medical expenses, that may push their overall medical expenses in a given year above 7.5% of their income. So they may be eligible to use those expenses to lower their income. State income tax and then property taxes. So this is capped at $10,000. So even if you live in California and you are taxed more than $10,000 on your salary, you're capped at $10,000 from a deduction standpoint if you're itemizing. Mortgage interest, the IRS also has limits that up to $750,000 of mortgage is deductible. So if you live in a state where real estate properties are higher, values are higher, you may not be eligible to deduct the full amount, but up to $750,000 is eligible to be deducted. And then lastly, our charitable contributions. And this is what I think of as the opportunity set and where you can really optimize your charitable or optimize your tax deductions is by being thoughtful with how you give and when you give. So what I want to note is cash donations are eligible to, you can get a deduction for up to 60% of your adjusted gross income for non-cash. So this could be donating stock, this could be donating, cryptocurrency, this could be, an artwork piece that you have. It's a little bit lesser from a percentage of your adjusted gross income, but it still could be a really optimal method to be able to donate to charities that you care about. So the next slide is going to look at what does this look like from a tax return perspective? And this form here is called Schedule A, and I won't get into the nitty gritty, but this is, if you itemize your deductions, this is the form that either you or your CPA will fill out. You're basically going to plug in each of these columns. And then if, again, the sum of all of these add up to be more than the standard deduction, it's going to be in your best interest to itemize. So you're capped on the state and local. Medical is probably not going to be relevant for most folks unless it is in an abnormal year. You have significant medical expenses. Your mortgage interest, if you own a property, you may be deducting it. So if you purchased a property this year and mortgage rates have gone up, it may be likely that you might be itemizing this year for the first time. If you're renting, you're probably going to be taking the standard deduction. And so that leaves the charitable contributions as the opportunity to be able to potentially itemize and get a little bigger bang for your buck in a given year by donating to charity. And so Adam's going to talk through, a little later on of what are some ways to be able to do that. Next slide, Martin. So tax planning with equity. So again, since a lot of our audience, is within the tech community or, in the startup world, a lot of you might be, thinking about, are there decisions I should make before the end of the year with my equity compensation that could save me taxes or just set me up for the future? And a couple opportunities there is, Martin, if you go to the next slide, let's start off by, just, do you currently own equity? And if so, what type? This will help me to kind of gauge, where we're at and what would be most applicable for this group.
All right, poll is live. Let's see. Okay, it's coming in hot. We have about half the people. Get another few seconds. We have a few more trickling in here. Go ahead. Give me one more second if you want to answer. Okay, well, very interesting results, Chris. It looks like about 48% people here, they have unexercised stock options in their company. 30% have already exercised options in their company. About 20% are currently vesting RSUs. And then the remaining 2% do not have equity currently.
Okay. So a lot of different flavors of equity, and we got a good mix. So, the next slide, I'm going to talk about, what are some planning opportunities for the different types of equity. And then I'm going to turn it over to Adam to really introduce, what is a donor advised fund and how that could be, something to consider before the end of the year. So starting off with just if you own shares, this could be in your company, or this could be just in a brokerage account. One way to potentially lower your income for the year is any of the stocks that are down. You could be able to sell those before the end of the year, lower your income by up to $3,000, and any residual or any losses above that amount get carried forward into the future, and they can help to offset any gains from any future stock sales. So the market overall is up, so there may be some pretty limited opportunities. But if you did realize some losses last year, so the market was not as favorable last year, so there were many tech stocks especially that were down. If you realized any losses or you sold stock before the end of last year, you may be sitting on some losses that could help to offset gains in the future. And so that's the second point there is gain harvesting, is maybe you want to be able to, get some liquidity to do a home renovation project, or maybe you want to get some liquidity so you can exercise some stock options. If you have some losses from the past and you have some stocks at a gain, you could sell the stocks that are up to the point that you have losses. It's a tax neutral event, so you don't have to pay any taxes out of pocket. And then you've been able to get that money that you can then use at your discretion, whether that is holiday spending, whether that's exercising options, or just reinvesting those proceeds into another investment. Another thing to point out for those folks that do have RSUs, especially individuals that are at a public tech company, publicly traded tech company, one thing that I've seen with a lot of clients that we've been working with is RSUs are considered supplemental wages. And those types of wages or income, the default withholding for federal taxes is going to be 22%. And the combination of many tech workers are highly compensated, and two, the stock market is up big time this year, could result in your personal tax situation being in a much higher bracket than the 22%. And if you're having taxes withheld on those RSUs as they vest at 22%, but you personally are, say, in the 35% bracket, there's an under withholding, and that sometimes can lead to an unpleasant surprise when you come to file your return. So something I have been looking at with some of our clients is, do they need to make an estimated tax payment before they file their taxes next year to be able to, one, save any penalties or interest from accruing, and then two, just to be aware of what they might owe, so that they don't file their taxes and then have an outstanding liability that they were not aware of. So some employers will allow you to adjust that withholding rate on RSUs that vest in the future. But just something to call out is, if you are vesting RSUs at a public company like a Google or a Coinbase, you may want to take a look at the withholding and just make sure that there has been sufficient taxes withheld so that there is not an unpleasant surprise next spring. The other thing, the last point here, is for individuals that have stock options. You may be granted incentive stock options or ISOs. The type of tax that would be potentially subject on exercise would be alternative minimum tax. So the unique thing about alternative minimum tax, or AMT, is you have a freebie that you can exercise up to a certain amount each year without paying any taxes. Now, that is dependent upon a couple of things. one of the large drivers is going to be the spread between your company's fair market value or 401(a) valuation and your strike price. The larger that spread is, the lower the number of options you could exercise before you incur an alternative minimum tax. But it's something to take a look at. Also, if it's a high income year for you, your gap is going to be larger than in a year maybe when your income is lower. So that's something that we've been taking a look at is there a way to get exercise without having to pay taxes? And then the other thing for individuals that hold non-qualified stock options or NSOs. So the delta between the fair market value and your strike price for these is going to be subject to income tax. And so one thing to look at is if it is a lower income year, maybe you took some time off of work for a portion of the year. Maybe you tried to target a specific tax bracket. If this year might be lower income than what next year is presumably going to be. So there's some ways to be able to, again, it comes to the lifetime tax strategy and thinking about, what is your tax situation this year? What's it likely to look like in the future? And how can we be able to make decisions to, again, save you taxes or take action with your equity in lower income years to set yourself up to be able to retain more upside in the future and also lower that tax exposure going forward. So with that, I'm going to talk about another tax strategy for those of you that are charitably inclined. And I'm going to give it over to Adam to introduce a donor advised fund.
Thank you, Chris. Very happy to be here and happy to talk about the value of donor advised funds and basically the higher level tax strategy around being more intentional about your charitable giving. Most people, not all, but most people do give to charity from time to time, and they tend to be motivated largely about the organizations they support and the causes that they believe in. But it turns out the charitable deduction is a very valuable tax deduction. It's one of the most valuable in the tax code. And as a result, there really are incentives in the system about how to do your charitable giving in a more structured way to take advantage of the tax savings that are available. And donor advised funds are a big piece of that, although many people have not actually heard about what a donor advised fund is. So I'm happy to share some information about what that is. Go forward. So a donor advised fund, the easiest way to think about it is that there's all sorts of tax advantaged accounts, right? There are 401ks and IRAs for retirement. There are 529 plans for college savings. And so one of the easiest ways to think about the donor advised fund is that this is a tax advantaged account that has existed for decades, that is designed to help take advantage of the benefits of charitable giving. And so it is just like one of those tax advantage accounts, right? It starts with just putting money aside. You can put cash into these accounts. You can actually donate assets like stock or crypto or mutual funds or ETFs. And when you put money into the donor advised fund, you immediately get that charitable deduction in that year. And that can be very valuable depending on what your year looks like. Once the money is in the account, it's invested. You get a choice of portfolios. It's invested tax-free, so you get advantage of that compounding. And then when you want that money to go to an individual charity, all you do is go to your donor advised fund and make a recommendation about what charity and what amount you want to go to it. And it usually takes seconds to do so. And then the charity gets the money. So it really is a wonderful financial product and a great way to organize your charitable giving, even without the amazing tax advantages that come from it. Move forward. So, why do people have donor advised funds? Well, it turns out that there are at least 3 very hard problems around charitable giving for most people. One, there's a budgeting problem, right? How much can you afford to give to charity? Most people don't think about this, but it turns out that like every other financial goal you have or anything where you put money, it's useful to have a number. And most people don't have that. And donor advised funds help solve that problem because you've set up this account with the dedicated money that you are putting aside for charity. The second problem has to do with taxes, right? The IRS, the calendar tax year is just between January 1st and December 31st. And that doesn't always line up with how we make money or when money comes in or when we want to make donations. Also, an increasing number of people have variable income, which means that you don't make the same amount of money every year. Some years you make a lot more money, some years you make less. And the way our tax system works is you will pay the highest tax rates in the years where you make more money, making it more advantageous to give to charity in those years. And yet it turns out that that's not how charities work. Most people support organizations like schools or religious organizations or cause-based organizations, and they want to give money regularly every year. And so managing taxes versus charity is a hard problem. And donor advised funds basically smooth that out so that you can make those decisions independently. And then, of course, the third hardest decision is who to give the money to. And as I just mentioned with the calendar tax year, with the budgeting problem, that can add stress to a problem that's already hard to do. And donor advised funds, because the money is invested tax-free, it gives you and your family the time to think carefully about which organizations you support, do the research on them, and then give when you're ready. Next slide. So, oh, go ahead.
Yeah. So this one, I was just gonna, talk through, with the power of a donor advised fund, one way to be able to really optimize your giving is to give stock, give highly appreciated stock. And Adam's going to go through a case study, for what that looks like. But, these are a couple of the companies that have had exceptional years. Many of the companies here that are listed are up over 100%. So they've more than doubled since the beginning of the year. And those type of stocks are the ideal candidate to be able to donate into a DAF. Also, the Magnificent Seven, or Microsoft, Amazon, Meta, Apple, those stocks are up big time as well. The combined average of those is also about near 100%. Will these names be the winners of next year? Who knows? And we're not here to guess on what that could be. But we do like to be able to plan around, what are the known facts? And, if you happen to work at one of these companies and have, vested RSUs or an employee stock purchase plan, or maybe you just own these companies because, your customers, you utilize them, you're familiar, but they've experienced some significant appreciation, and you're trying to figure out, do I want to own it, to the same extent that I do right now, or I want to be able to give to charity? These are probably going to be some of your best candidates to give. One thing to note, though, is you just want to make sure that you've held these shares for at least 1 year to be able to get the biggest benefit for a donor advised fund when it comes to your taxes. So wanted to talk through a case study with you. If this is similar to anyone's situation, you could be a really good candidate for a donor advised fund. So in this scenario, Amanda works at Meta. Meta has had a phenomenal year from a stock performance, and she's been investing RSUs. And her partner, Andrew, is a business owner who has also had a really strong year. So as a household, their income is projected to be about $125,000 higher than what last year, or what even a more normal year is shaking out to be. This is a good year. Again, higher income years, your tax deductions are going to be even more powerful. So a little context on them. They give about $6,000 per year to their church and to some other local charities. They did buy their first house, so eligible for deducting mortgage interest. And they're trying to think through, is there anything they can do before the end of the year to lower their taxes, but still be able to do what they want to? And, they value giving to charity. And so one strategy that we like to introduce to folks is bunching your charitable contributions. So what does that mean? On the next slide, we can talk through what this means. So let's say that Andrew and Amanda, they're limited to $10,000 on their state taxes, that is deduction. So that's capped out there. Let's say they have $11,000 of mortgage interest that is deductible, and they like to give $6,000 to charity. If you add all those up, they're going to be lower than the standard deduction, which is the IRS freebie. The freebie is $27,700. The combined of those is $27,000. So effectively, they're not getting any tax benefit for their donations. Now, most people don't just give for the tax benefits, but if you can be able to get a little bit, of a tax, benefit for doing something that you already plan to do, that's really kind of the sweet spot. And so a way to do that, especially in a higher income year for them, is to be able to bunch or pre-fund charitable contributions for the future. So a donor advised fund, as Adam said, is a designated charitable account or a bucket that you could be able to give from. by putting money into that this year and pre-funding, say, 4 years worth of donations, so $24,000 into 1 year, you get the tax deduction when it's going to benefit you the most in a high income year. And then there's $24,000 in a donor advised fund that you can keep in cash, or you could reinvest into investments or into crypto, and it will help to maximize and grow your donating power in the future. And then you would be able to take that standard deduction in the future and give from your donor advised fund, as opposed to giving, out of your bank account or other sources each of those next 4 years. So that's the power of clumping. And you can see here that saves them about $6,000 of taxes. So you do have to, put the money in now. But if you have desires to be able to give to charity, and you want to be able to figure out a way of how you can also be a little more tax savvy in a high income year by just bunching or clumping those charitable contributions via donor advised fund, as Adam said, can help smooth out both from a charity's perspective, but also for your perspective to get a little more bang for your buck on the tax front. So with this, want to just throw up another poll of, do you have gains in any of these asset classes? And that could be stocks, index funds, or ETFs, crypto, or maybe you don't have any gains right now.
All right. See where we net out here. Everyone is still answering. A few more seconds. You want to go ahead and respond? Okay, it looks like a few are trickling in, but okay. So 34% of you have individual stocks gains. About 39% of you have some index or mutual fund gains. About 11% of you have crypto gains, and remaining 16% don't have any gains this year.
All right. Well, it sounds like a lot of people do have some gains. So one way to be able to give with some of those stocks or crypto holdings that are up is going to be what Adam walks through in this example. So Adam, I'll turn it over to you.
Yeah, thank you, Chris. So happy to talk through this, and I think this illustrates really one of the more valuable tax strategies that happens with charitable giving. Not everyone has gains in investments like stocks or ETFs or mutual funds or crypto, but if you do, there really is a very compelling case to always donate stock or appreciated assets rather than donating cash. Most people support the same charities every year. They send money and they don't think about it. They'll write a check, they'll use a card on a website, etc. Even for very large amounts. Like in this example, you have a couple, Justine and Ben, who typically give about $10,000 to charity in a typical year, and they usually use credit cards or checks. But they're also investors, and they happen to hold Apple stock, right? Apple's done very well recently. And as Chris mentioned, they've held the stock for more than a year, and they have a gain in the stock. And so it turns out when you donate assets like stock or crypto, the way the tax code works is that you get a charitable deduction for the full market value of those securities, right? So it doesn't matter what you bought Apple stock at, you get the deduction based on what price the stock is at today. And so if you bought it at a lower price, but now it's worth $10,000, in this example, giving 51 shares of Apple, you get the charitable deduction because you've held it more than a year and you have a gain. You get to take the deduction on the full market value of that security. Now, of course, you get a wonderful charitable deduction for this on your taxes, right? You get to write off that $10,000 just like a cash donation. But it turns out when you donate stock, you get this extra benefit. And that benefit is you're never going to pay the capital gains taxes on those Apple shares, right? When you hold a stock and it has a gain, there actually is a liability built in there. Someday, when you sell that stock, you're going to have to pay taxes on those gains. And if you live in a high tax state, you're talking about not only federal taxes, but also state taxes that can be quite high. When you donate that stock, you eliminate that liability. And here's the magic. It turns out that if you want to own that stock long term, there is no wash sale rule when it comes to donating stock, which means you don't have to wait 30 days. So you can donate those shares that had a low cost basis, those shares you bought for a lower price, and use the cash that you would have given to charity to just buy back that stock instead. So it really is a win across the board. It results in a lower tax bill for you. It results in more money for the charities involved. And it doesn't have to mean that your portfolio doesn't stay diversified. We've even at Daffy built a free donations calculator. If you want to play with some numbers or real stocks that you have, the URL's right here. You can actually go to daffy.org/stock-donations-calculator and actually enter whatever security you hold, whether it's a stock, it could be an ETF or a mutual fund. And you can play around to see how much you might save in taxes by donating that stock to charity instead of donating cash. Now, I will warn you, there's a problem. Most charities in the United States, there's almost 2 million charities across the US, something like 1.7, 1.8 million. And only a few thousand are actually set up to take stock or assets, or let alone crypto as donations. This is where a donor advised fund really provides a huge advantage, because the donor advised fund like Daffy can handle stock, ETF, mutual fund, crypto contributions, and then get cash to the charities that you care about. So it's an amazing way to take advantage of this strategy without having to find that 1 in a million charity that actually can handle the asset that you want to donate. So you might be wondering now, how do you establish a donor advised fund? And it turns out it's very, very easy to do. So Daffy, obviously, my bias, Daffy stands for the Donor Advised Fund for You. It's kind of a little clever play on words and an acronym. But it actually makes it very easy for anyone to set up a donor advised fund. And there's really no minimum. And in fact, it's free, under $100. And so Daffy allows you to donate through cash. You can link your bank account. You can use a card, a debit card, a credit card, even Apple Pay through the app. But you can also contribute stocks, ETFs, mutual funds, or crypto. There's 13 different tax-free portfolios to pick from, everything from conservative portfolios that are invested in money market funds and bonds, to low-cost index funds from Vanguard, ESG portfolios from BlackRock, and even for the more adventurous crypto portfolios for those who believe in that asset class. Daffy supports almost every legal charity across the United States, so you can rest assured that if you want to donate money to a legal charity, that you can. And you can automate your donations and contributions, putting aside money regularly into an account for charity, and also setting up recurring donations so you don't accidentally miss supporting the organizations you care about. For most people, this is just good financial housekeeping. Having all of your donation receipts for the charities you support in one place every year at tax time is amazingly valuable. And Daffy provides that accessible both through the app and the website. And then, of course, one of the great things about Daffy is that it does not actually charge you additional asset management fees like most donor advised funds. Most of the big donor advised fund providers out there end up charging you a fee, typically 50, 60 basis points on whatever assets you store in the account. Daffy doesn't do this. Like most nonprofits, Daffy charges a simple membership fee, which ranges from $3 a month all the way up to $20 a month, depending on the size of your contributions and what features you need from the service. We also have some really some perks for folks listening to this webinar. If you want to try out using Daffy, we're actually providing $25 to get started. So when you open a Daffy account and fund it, you'll get an extra $25 to give to the charity of your choice. And if you use the link shown here, which is especially for our friends at Secfi, you'll get that benefit.
Awesome. Thank you, Adam. So now we want to just open it up. I know we try to, keep that to be under 45 minutes. I know we're pretty close to time, but we do want to open it up. I've been trying to answer some questions that came through in the chat. But if anyone else has questions, either for me or for Adam, happy to take a look and field those and try to give some answers before we sign off today.
Yeah, I know we have a few questions coming through, and Chris, I know you've been answering a few, and I don't know if everyone can see those, so maybe we can run through those really quickly too. Someone asked, do AMT credits offset in future years? And Chris, you did answer this one, that it's limited to the difference between your income tax liability and your minimum tax in a given year. You also answered one on how do you classify high income? You
Yeah.
said it's very subjective and personal. I know, because you talked about high income years and offsetting those. And so I think what you were probably saying is it depends on what's high for you, depending on other years. Um, there's a question about how do we know how much equity to exercise and when. Yes, Secfi has some great tools to help you plan these out and model out different ways to exercise and when. So head over to Secfi if you don't already have an account. These tools are free to use. And you can work with someone like Chris as well. And he mentioned a lot of different strategies as well. So it's important to dig into those. And I know we have a few more questions out here. One was if you were living in California but now live in Europe, will California still tax someone, or will it just be the federal government?
Yeah, so it's a good question. Again, I don't know this person's situation, but if you were granted any form of equity, whether it's RSUs or stock options, and you started to vest those while you were a California resident, there is a good chance that California still does have claim to some of the taxes associated with that income when you do realize it, even though you are now residing in Europe. So I would say probably good to chat with a CPA, but there is a good possibility that you may have a California tax implication.
We also have a question that someone is currently vesting RSUs, but they're in a blackout period. How do they loss harvest in that case?
Yeah, so it's a good question. It's a tough situation. I think it depends on company specific guidelines about what is a blackout period, like what transactions are eligible. In my experience, a blackout period means that it means that any transactions, whether it is selling stock, buying stock, exercising options, are restricted. So I would say you could see if that blackout period is lifted before the end of the year. But if it's not, I am afraid there may not be any opportunities to harvest losses in calendar year 2023, but it could be something you take advantage of in 2024.
Okay, and we have another question too about, is it possible to amend tax returns from previous years to itemize deductions?
Yes, so it is possible to amend previous year's tax returns. Typically, there's going to be a cost to doing that. So I think the important thing is to look at is the cost to amend and refile a return, is that going to be less than any tax benefit you might get for itemizing? So I would say yes, it's possible to amend, but just want to take into account what are the costs and the potential benefits of doing so.
Okay, and we have a few questions here about DAFs. So hopefully Adam will be able to answer these. Any advice for those that are using robo-advisors like Wealthfront in terms of donating individual stocks or ETFs or mutual funds held there over to a DAF?
Yeah, well, there's good news and bad news here. I think that it turns out that almost every brokerage out there supports the ability to send stock to another brokerage or send stock to a charitable organization. So at almost every brokerage, it's very easy to use something called DTC. We have instructions on daffy.org to kind of send stock, ETFs, or mutual funds. Obviously, doing crypto is a different story, but also very easy to do. Not all robo-advisors support that feature, and it's on a case-by-case basis. So really the best way to get the answer to that question is just to contact support at whatever robo-advisor you're using to see if they support DTCing shares out. Some do, some don't. Also, if you contact Daffy, we're happy to tell you which robo-advisors we've done transfers with before and which ones we haven't.
Thank you. We had a couple of questions about that. And then we have another question about if the capital in a DAF account appreciates in value, what happens to those gains?
Well, it's good news for some lucky charities out there, some lucky organizations. The accounts are tax-free, but the money can only be used to make donations to charitable organizations. That's the price you pay for getting that charitable deduction up front when you made the contribution. And so the gains are tax-free, whether it's dividends, capital gains. All the portfolios at Daffy, for example, are rebalanced daily. but you don't owe any taxes on those. Those assets are no longer held under your individual name. So there's no way to claim those gains for yourself or other needs aside charity. But for a lot of people, this is one of the things they like about donor advised funds, right? They'll use that bunching strategy that Chris talked about, or in a good year, they'll put aside more money than they need for 1 year to give to organizations. And then that money grows over time. And so if you put aside enough money to support your charitable giving for 3, 4, or 5 years, who knows? Maybe gains help you fund the 6th year of giving, which is kind of a fantastic feeling when you make the effort to put money aside for charity.
All right, thank you. We have a few more questions I'll try and get through. Thanks everyone for staying. Chris, this is for you. I know it's a bit of a big question, but it's do you recommend exercising your options before your company goes public or waiting until after? Again, I'll say that we have a lot of great tools on Secfi to help model this out, to help you understand the costs and the taxes implications of decisions before and after. But Chris, I'll let you add your thoughts as well.
Yeah, I will say, this is also a highly personal decision. Certainly, there are some risks associated with exercising stock options anytime, especially if your company is not yet publicly traded. But there can be some real benefits to exercising. I think a couple of things to keep in mind would be, what is your strike price? What are the tax implications of taking action to exercise? If your company, for whatever reason, was not to have a successful exit event, would the money that you're thinking of putting in, would that, detract or, limit your ability to do anything that you are aspiring to do from a financial perspective? So I think, there can be some real benefits to exercising before a liquidity event. There are some real risks. And I would say, talking that through with an advisor like myself or, someone else to kind of help you think through all those considerations and help you come up with an informed strategy would be my recommendation.
And Chris, we have a question too. For someone that has major tax implications from shares issued by a private company, any general advice for what someone like in that situation could do?
Yeah, so I will say it depends upon what type of tax implications this individual is facing. Is it an income tax? Is it an AMT? Is it a capital gain, exposure? But I would say, a donor advised fund could be a great solution to help offset, any capital gain or income tax liability. With AMT, I will say AMT is a bit more tricky for what that might entail. But I would say, typically like strategies to defer income or, lower your income in a given tax year would be a way to help reduce tax liability. I would say without knowing too much more context, it's tough to say. But I would say those are a couple of things that I would think through.
Thanks, Chris. And Adam, we have a question. Is there any way to donate vested but unexercised stock? Or does that stock have to be exercised or publicly traded to donate?
So I think that refers to stock options, right? Not stock. It's restricted stock. Once you vest, you have it. So I'm going to say for the most part, no. Stock options are usually contractually tied to you, especially if you're a current employee. Even if you're an ex-employee, usually the answer is no. So you're going to make the decision first about when to exercise. And in fact, that actually is a common point for actually putting some stock into a donor advised fund. There are all sorts of transactions that have tax implications. Chris has talked about some of them today. And usually it's at those moments where it's very thoughtful to think about, well, is this the moment where if I contribute a percentage of that stock to a donor advised fund, I might get back some of those taxes, right? Because usually exercising stock options or selling stock can result in a big gain in a calendar year. It also can spike your income, which can increase your tax rates. And so that turns out to be a very good time to think about whether it makes sense to take some of those shares, donate them, and get some of that benefit back. I will caution everyone, though, that remember, one of the problems is you really have to hold stock for at least a year to take advantage of the benefits I talked about earlier, right? Stock held less than a year doesn't usually make sense to donate because you only get to deduct the cost basis of what you paid for them, which in some cases might be quite low, especially if you have a low strike price stock option. Certain types of stock options have different tax treatment than others. So anyway, short answer is no, you can't donate the stock options that are vested. Yes, you should think about it. But very often what you end up doing is the stock that causes the tax liability is not necessarily the stock that you have to donate, right? So maybe you're exercising a stock option and you're going to have a big tax bill this year, but you can't donate that stock to a donor advised fund. But maybe elsewhere in your portfolio, you've been holding a Vanguard index fund for several years. Maybe you have other stocks elsewhere. Those stocks have gains. Even a boring index fund, if you hold it 5, 10, 15 years, might have accrued significant capital gains. And so sometimes the right thing to do is pair a transaction like a stock option exercise that triggers taxes with donating other assets that you have in your portfolio with gains that you've been holding for a longer period of time.
Yeah, I think that's a great point, Adam. That's something I think of, thinking of all of these different kind of strategies and how they coordinate with one another. I think that's where you can really get some powerful outcomes.
Great, thanks. And I think we have time for one more question. It's a good question to end on. I think Chris and Adam, maybe you can both chime in, is which professional should you consult for tax planning strategies? Is it a CPA, a financial advisor, both? Are there any others out there that people may want to consult?
Yeah, I will say, I'll start by, I think there's value to both professionals, both a financial advisor and a CPA. I think, you can have, I think when the CPA and the financial advisor collaborate, I think can be where, that leads to the best, solutions and the results for you as the individual or the client. I think a financial advisor is going to do a lot of, proactive tax planning in addition to other financial considerations, not just with equity or taxes, but helping you with where you should be saving, to what type of accounts, or how should you, be ready to purchase a home in the future? How should your funds be allocated? How much home can you afford? I think a good CPA is not only going to be able to, do your tax return accurately, but I think they can also help with doing some projections. And especially when it comes to alternative minimum tax, I will say that is a beast. There's a lot of complexities with that. And I think having a CPA that also specializes in equity compensation, especially alternative minimum tax realm, I think is really what you're looking for. And I think can provide a lot of value and save, far beyond, what you might pay him or her in any kind of, annual fees.
I think Chris is being a little too modest, but I think that's fair given that he has a bias here, of course. But I will just say that both types of professionals are very valuable, but for different reasons. A great CPA, a great accountant, like Chris said, can easily pay for itself, because when you have a big financial transaction, it could be real estate, exercising stock options, etc. A good CPA can not only give you advice about that, but they can actually run scenarios, real scenarios in taxes, not in theory, but against your exact personal tax situation, which can affect decisions, right? You can have two people that look very similar on the outside, but actually are in very different tax situations, and the CPA helps there. The problem is the CPA doesn't really have a complete financial picture of your financial life. And a lot of strategies, like I was just talking about earlier, actually involve crossing things that are happening on one side of your life with another side. And a good financial advisor can help coordinate or look for ideas that go across your entire financial life and don't have tunnel vision about a particular transaction. And so, as Chris said, if you have both, it's really a phenomenal collaboration that really is the ideal when they're all working together. But depending on your situation, sometimes a CPA can be exactly what you need. But if you're looking for holistic advice across your entire financial life, there's really no replacement for a financial advisor providing that visibility and those insights.
Well said.
Thank you both. I think that's a good place to stop. We will be sending out the recording to everyone, as well as a way to follow up. If you have any additional questions for Chris or Adam or Secfi or Daffy and want to learn more, we'll be sending out a way for you to follow up with us. Thanks everyone for attending. Have a great afternoon.
Thank you.